Hello, and welcome to Financial Fridays with Dawn, where I empower you each and every week to live a happier, healthier, and wealthier lifestyle. So we're just getting back from having a great summer. Hope everyone else had a great summer. And last week's topic, we covered something fun, how to attract more money into your life. And this time, we're going to get back on track with more financial topics. And since it's September, which is Life Insurance Awareness Month, I thought I'd talk more about that, give you some statistics about life insurance, go over the different types, and just answer any questions that you may have. So first, let's go with some statistics. So first, only 59% of adults actually have any type of life insurance, and this even includes policies that work. So there's 41% that don't have any insurance whatsoever. So that is quite a lot of people. And the main reason, and then actually of that 59%, only 1 in 5 think they have enough coverage. So of even the people that do carry life insurance, the majority are underinsured. And also now they even go to say that 1 in 3 families, they would have a financial disaster if the breadwinner died within just 1 month. So life insurance, it's very important to have. And why do people not have life insurance? Well, one is they think it costs too much. They're like, oh, that's too expensive. I have some statistics here that most people, that's their main concern, is that it costs way too much, I don't need this. And they actually overestimate that cost. And it's millennials that are actually overestimating that it costs too much. But there's different types of insurance that fit all types of budgets. So let's just go over some reasons why you do want to have life insurance. Well, obviously, it's called life insurance, so it provides a death benefit. So that's one of the main reasons. You want to make sure you're replacing your income, so that way, if a breadwinner does die, you could survive. For example, I had a client, luckily, she bought more life insurance on her husband, and it was just a simple term policy, so it was very inexpensive. And then he died actually 2 to 3 years later. And he was the breadwinner. She does not work. She's on disability. So without that death benefit, it was about $500,000, she would not be able to survive. So fortunately, we had that in place. And when the time came, yes, it was an emotional disaster. It was so horrifying when you lose a spouse. But financially, she was going to be okay, amongst other things that we had going on for her. So life insurance, it's very important to have that. Other reasons to have it is it helps with college planning. It's a good way to shelter the assets from the financial aid form. So you could have tons of money into life insurance and they don't count that against you. So you'll be eligible to get more scholarships or more merit-based aid, even financial need aid. And we'll talk more about college planning in another segment. Another reason is to pay estate taxes. Some of the people are going to have taxes due, or people put loads of money into their IRA thinking that's the best way to save for retirement and to leave it to the kids. Well, when they pass on, the kids are going to be hit with a huge tax bill, so life insurance can help pay those taxes and estate taxes. Life insurance also gives you peace of mind that your family is going to be taken care of in case you're not here. So those are just a few of the benefits of having life insurance. And I know you can, if you want to learn more about it, you can go to my website. We might have talked about this before. It's called the 10-Minute Lesson on Life Insurance. So click on dsfinancialstrategies.com, click on Dawn TV, and then scroll down. I believe it's under Circle of Wealth videos. It'll be the 10-minute lesson on life insurance. And that goes over how to really fund life insurance, and I can help you a little further with that. But it just gives you a little idea on using it as a parking place for your money, which I know we have talked about in previous episodes of Financial Fridays. So now let's just talk in general. Okay, what are the types? There's term insurance, and you can think of term insurance as if you're renting. You basically pay for a certain amount of time and then it's done. It's really inexpensive, and then when you go to renew it later on, say you buy a 30-year term, it's going to be really expensive, and most people don't do that. So they just drop the coverage. And actually only 3% of term policies are ever paid out according to a Penn State study. Why? Because people convert within a couple of years, or again, it gets too expensive and they just drop the coverage as you get older. So that's term. Inexpensive, pay for a certain amount of time to give you the coverage that you need. Then there's whole life. Now, whole life is permanent insurance, so it's going to be there the day you die as long as you pay your premiums. You get dividends, it builds cash value, and you want to always go with mutual companies. Those are owned by the policyholders. And then there's some combinations in between. There's universal life, which is tied to interest rates. You pay a premium and it'll be flat for that amount of time, like say for your whole life. But what happens is the cost of insurance, instead of being baked in there like it is with whole life, you're actually going to see it on your annual statement. So every year that cost of insurance is going up. Now it's still going up in whole life, but you don't see it because they spread it out throughout the contract. So we won't get into those. All actuaries calculate all that stuff, and that'd be quite a boring show here. So we won't talk about that. So that's universal life. Think of it as like a permanent term insurance is a way to increase, because again, term insurance, the cost goes up every year, but you have some level term, but the internal cost which is already calculated by the actuaries. Then there's something called variable universal life, which I'm not a fan of because it's basically tied to the market. So yeah, when the market's doing well, you're going to do well, but then you have insurance costs on there. So why not just go be in the market and have your insurance do its insurance thing? Again, going back to those tanks, our green tank is our safe tank. That's where we want our permanent life insurance. And then our yellow tank is the market. So I'm not a fan of variable universal life. Maybe in some certain circumstances it may work, but like I said, I'm not really a fan of that. Just go invest in the market. Then there's another type called index universal life. So now index universal life is tied to an index. You're still in a fixed account, but you get credited based on what an index does. Now they're not going to give you the full credit. So say the cap is like 10%. If the market does 20, you're going to get 10. But what's really nice, if the market goes down to like -20, you're going to get 0. So you're not going to go backwards. You're going to keep moving forwards. So that's another combination in between on the way from term to whole life. So now there's many different reasons why you would choose one over the other. I was actually talking with one of my regional vice presidents, and because I said, you know what, whole life is pretty good, and so is index universal life. But it's like the whole life people are all about whole life, and that's the answer for everything. And then the IUL people IUL is the way to do everything. But again, I'm kind of in the middle. It depends on the circumstances. And like this RVP was telling me is that once you have your foundation with whole life insurance, that's basically like your permission slip. So the other policies that you buy, they could be IULs because they have a potential to earn a higher rate of return. And notice I said potential. So that's how that works. And then something interesting that I learned too, when talking about, because again, when I do policies, like what I have for myself is I overfund my life insurance policy. So I pay more than I'm supposed to, so the cash value builds up bigger. And again, referring to that video I just directed you to, we'll explain all that. I just don't want to sit here and take up all your time about that. So where was I? So, oh yes, with the IULs, like, so when you're taking loans, because again, we want to always take loans because that is tax-free. I believe it's section 7702 under the tax code, loans are tax-free. So that's the beauty of paying all this money into life insurance, and then we could withdraw from the cash value via loans. So now when you're talking about an index universal life policy, the loans are different. There's standard loans and then there's preferred or variable loans. So what that means is a standard loan, you're going to get a rate of like maybe 4% fixed. That's just fixed. That's what it is for the life of the policy or the life of the loan. Then the index loan it's going to vary. Basically, maybe say it's 4.5%. So now that loan amount that you took out, because your money always stays in the policy, you're never taking your loan against your policy, it's against the insurance company. So their money is still there as if you never took it out. So what happens is that portion of the loan amount is put into like the indexed account, and based on whatever it earns, you're going to get the arbitrage. So if we're in an up market, you'll beat that, and maybe you could actually make money on that amount that is loaned out. But then also conversely, so say you're charged 4.5%, but the market does -10, you're down in that loan value, down -14.5%. And I've read all these books with like Patrick Kelly about tax-free retirement, and they talk about index loans are the greatest. So you want to be careful. If you have an index loan, you got to watch what the market's doing. So talk to your agent, because again, when it goes down, now it's not your entire cash value, so just your loan. But some people might have loans of $100,000 on their policy, 10, 20,000. So now if we're talking about 1,000, that's not too bad, but still, nobody likes to lose more than they have to. So, and you can always switch each carrier has certain rules. You can switch from the standard loan to the index loan. And I know this is probably like losing a lot of people and like, they're like, we don't care about this. So that's why you talk to a professional like me. So I'm watching these things for you when we get to that stage of your policy. So this is why life insurance is very important to have. Again, for your loved ones, for yourself, even single people too, because most people, life insurance is basically, you have to qualify for it. Not everybody gets it just because you want it. You have to pass health exams and all that and be healthy. So the younger you are, the better it is, the cheaper, and also the better ratings that you'll receive. So I like to plan accordingly, start it with term insurance and do some whole life, maybe IUL, depending on what we have going on. Each person is an individual and has unique circumstances. And then we build our foundation from there. Then we go into the market when the timing is right for that once we have the base, then you could move forward with your plan. So hopefully this was very helpful. If you have any more questions, please reach out to me. My number is 215-660-0288, or go to my website and you can email me from there, www.dsfinancialstrategies.com. And also, I'd be happy to sit down with you, look at the current policy that you have, because I know when I first got into this business, when was it? 13 and a half years ago, my job was basically cleaning up messes. By that, I mean universal life policies were blowing up because back when they were sold in the early 80s, interest rates were really high. So they just told clients, pay $25 and you'll be fine. You're going to have all this money and life will be great. Well, that wasn't the case because, as you know, interest rates fell and then policies were blowing up. So a lot of people were not happy about that. And that's another reason why people hate life insurance because, oh, it's a waste of money. Well, that's why, again, you want to sit down with a professional and stay in touch with your agent because if things change, but now they have certain protections in place and now there's the industry, you can't quote such high illustration rates or anything like that. But still, I'd be happy to take a look at that for you because no one wants to find out, and I've had this happen, like people are in their 60s and their policy is going to lapse in a few years. And that's not really good. You paid all that money and now you're going to be out of coverage when you probably need it the most because obviously the older you are, the chances of you're going to die is higher than when you're younger, statistic-wise. So you want to make sure you have, if you bought a permanent plan, you want it to be permanent, meaning till the day you die, it's going to be there. So I'd be happy to look at everything for you. All right, well, I hope you guys enjoy the weekend, and as always, I continue to empower you to live a happier, healthier, and wealthier lifestyle. Have a great day.